Okay, stop me if you've heard this one before, but have you actually really looked at the price of gold lately?
It is hard to miss.
Because I feel like I blinked over the weekend and we woke up in a completely different universe.
Yeah, we're sitting here. It's early February 2026, and the charts are, well, they're intense. Gold has been bouncing between $5,300 and $5,500 an ounce.
$5,500.
It's staggering.
It feels like 5 minutes ago people were losing their minds because it broke 2,000. I remember when 3,000 was the moonshot prediction.
And that's the context we're operating in. We're seeing record highs, but with that comes this, wild volatility. It swings hundreds of dollars in a week.
Which is exactly why we need to do this deep dive right now.
Exactly.
Because the instinct when you see those numbers is just to stare at the metal itself.
Yeah.
Buy a coin, buy a bar.
Bury it in the backyard.
Right. But today, we're doing something different. We're peeling back the layers on the actual businesses. The giants, the strategists, the bankers who are pulling this stuff out of the ground.
We're looking at the engines behind the commodity. And to do that, we're breaking down a specific analysis from late January 2026. It's titled WealthForge Investing, Gold Stock Spotlight.
And what I love about this report is it doesn't just lump gold stocks into one big bucket.
No, it breaks them down into four distinct personalities, you could call them.
Which is so helpful because, let's be honest, not all gold miners are created equal. But
Right.
before we even whisper the word stock, I know you have to do your thing.
You do. And I'm going to interrupt our flow gently but firmly right here.
Go for it.
It is crucial to state the disclaimer from our source material. The discussion we're about to have is for general informational purposes only. Neither this deep dive nor the source creators are licensed financial advisors.
Translation: don't bet the farm based on a conversation you heard us having.
Exactly. Nothing discussed here is a recommendation to buy or sell anything. You have to do your own research or, consult a professional. The market is just too wild right now.
Okay, legal box is checked. Let's get into it. 4 companies, 4 personalities. We've got the heavyweight, the efficiency expert.
The safe haven and the banker.
It's a great framework. Because just saying I own gold stocks isn't enough in this market, is it?
Not at all. The how matters just as much as the what.
So let's start with the big one, the heavyweight. Newmont Corporation, ticker NEM.
You really can't talk about gold mining without talking about Newmont. They are the world's largest gold producer. Full stop.
And the scale is just mind-boggling.
It is. We're talking about a company that controls over 100 million ounces in reserves.
100 million. It sounds like something out of a movie.
It's massive.
Yeah.
But here's the key takeaway for an investor. That number represents what we call operating leverage, meaning when you have that much gold on the ground, your company's value is incredibly sensitive to the price of gold. If gold goes up, the value of those assets skyrockets.
So they're the volume play. If you think gold is going to 10,000, you want the company sitting on the biggest pile of it.
Essentially, yes.
Yes.
Newmont is the proxy for the gold price itself, and they've been busy. The source highlights their recent acquisition of Newcrest.
Right, that was a huge deal in the industry.
It was. It pushes their annual production toward 7 million ounces a year, but more importantly, it diversifies them geographically.
They're now spread across the Americas, Africa, Australia.
Which is all about risk management.
How so? Is it just about having more dots on the map?
In mining, it's critical. If one country changes its mining laws or raises taxes or has a strike, you're not sunk. You have operations elsewhere. Newcrest gave them a massive, stable foothold in Australia.
Okay, so they're huge. They're everywhere, digging up a ton of gold. But here's where the source got really interesting for me. There's a disconnect.
You spotted it. It's glaring if you look closely.
I mean, gold is at record highs. Analysts rate Newmont a buy or overweight, but the average price target is around $106.
And in January, it was trading at what?
125 to 130. Wait, isn't the target supposed to be higher than the current price if it's a buy?
Usually, yes. And this is a fascinating tension. It suggests a conflict between the long-term fundamental view and the short-term market mania.
So unpack that. Who's wrong? The market or the analysts?
Well, wrong is a strong word, but analysts are looking at fair value. They see the long-term value from the Newcrest deal. They love the leverage, but the market has gotten ahead of the spreadsheet.
The stock price surged because gold hit 5,500.
Exactly. So it's like the market is throwing a huge party, and the analysts are at the door saying, hey, technically you guys shouldn't be partying this hard yet.
I like that. So there's some near-term downside risk then.
That's what the source suggests. If gold dips, Newmont might correct faster because it's running so hot. But the buy rating is still there because, fundamentally, if gold stays this high, the company is a cash machine.
It's a momentum versus value fight.
A classic one.
Yeah.
And speaking of cash, they do pay a dividend, about $1 a share.
Right, the yield is just under 1%. But the history.
38 consecutive years.
That's consistency.
It tells you something.
Okay, so that's Newmont, the heavyweight. Let's pivot to our second character, the efficiency expert.
This brings us to Barrick Gold. Ticker, GOLD.
Still the best ticker in the business. How did they snag that?
Hard to beat. So Barrick is the second largest producer, but if Newmont is the volume play, Barrick is all about the margin play.
The source focused on their cost control.
This is the absolute key to understanding Barrick.
Mm.
You can't control the price of gold, but you can control how much it costs to dig it up. Their all-in sustaining costs are around $1,300 per ounce.
Okay, let's do some napkin math. If it costs them $1,300 and they sell it for, let's say, $5,300.
You are looking at a $4,000 profit margin per ounce.
That is just wild. That's a pure profit spread.
And that's the power of cost discipline. When prices are high, everyone makes money. But if gold were to drop back to $2,000, Barrick's low costs protect them. They stay profitable.
It's the difference between a gas guzzler and a hybrid. They both drive, but one hurts a lot less when prices change.
Perfect analogy. But there's a twist with Barrick. They aren't just a gold story.
Right, the copper. I saw this. Why should a gold bug care about copper? They feel like opposites.
They care because copper is the metal of the energy transition.
Ah.
You have to look at the macro picture in 2026. Electric vehicles, wind turbines, upgrading the grid. It all needs tons and tons of copper.
So it's a hedge. It diversifies their revenue.
Exactly. If demand for gold as an investment wanes, the world still needs copper for its infrastructure. It's a very strategic plan B.
And the analysts, what's the sentiment?
It's a bit cleaner here than with Newmont. Generally positive. Buy ratings. The price targets are in the $49 to $51 range.
And they have a dividend, too.
They do, 40 cents annually, which gives it about a 1.9% yield. And again, look at the longevity paying for 39 years.
You see a pattern here. These are not startups?
No, these are earth-moving conglomerates.
Okay, so let's say I'm a listener who sees gold at $5,500 and thinks, I want in, but I'm terrified of political coups or governments seizing mines. You know, the scary stuff.
Then you're looking for our third profile, the safe haven, Agnico Eagle Mines. Ticker, AEM.
And the source puts a huge emphasis on where they dig.
Location, location, location. It works in real estate, and it works in mining. Agnico produces about 3.5 million ounces a year, but look at the map. Canada, Australia, Finland, and Mexico.
So not exactly places known for sudden regime changes.
Compared to the broader industry, these are Tier 1 jurisdictions. You have strong rule of law. That stability is something investors will pay a premium for. It eliminates a massive chunk of geopolitical risk.
But safety usually comes with a cost, right? Is Agnico just the boring bet?
Not at all. And this is the surprise. Agnico actually has lower costs than Barrick, around $1,200 an ounce. But the real headline, the thing that makes finance nerds sit up straight, is the balance sheet.
Oh, I highlighted this part. They are debt-free.
It is incredibly rare in this industry.
I mean, mining is all about huge capital spending.
Massive trucks, processing plants. To do that without carrying long-term debt is just a testament to incredible financial management.
So when they make that huge profit margin...
It's not going to a bank to pay interest. It's going to the bottom line or back to shareholders. It gives them options. If an opportunity comes up, they can jump on it.
And the analysts love it.
They do. Overweight to buy ratings. Price targets between $217 and $222. And a pretty substantial dividend, $1.60 annually.
And the streak continues. 43 years of paid dividends.
They are the steady Eddie of the group, the sleep well at night stock.
Okay, so we've got the giant, the cost cutter, and the safe haven, but there's one more. And this one. This one feels like cheating.
Oh, the banker. Franco-Nevada, ticker, FNV.
It's cheating because they don't actually dig any holes.
They are the rule breaker.
Yeah.
Franco-Nevada is not a mining company, not in the traditional sense. They are a royalty and streaming company.
Okay, break that down for us, because streaming sounds like Netflix, not gold bars.
It's a great model. Imagine you want to build a mine. It costs billions. You go to Franco-Nevada. They're the banker. They give you the cash up front.
Uh,
In exchange, you agree to give them a percentage of the gold you find or the right to buy it at a deeply discounted price forever.
so they just write a check, sit back, and wait for the gold to show up.
In a nutshell, yes. They don't deal with fuel costs. They don't
Yeah.
deal with labor strikes. They don't worry if a giant truck breaks down.
That sounds like a much better business model.
Well, the margins certainly reflect it. The source notes their margins are often around 90%.
90%. That's software company territory.
It is. Because their overhead is just an office full of smart geologists and accountants.
Yeah.
And it lets them diversify wildly. They have a portfolio of over 400 assets. Gold, silver, energy.
So if one mine collapses, they have 399 others.
Exactly. It significantly lowers the operational risk. And here's the hidden value. Exploration upside.
What do you mean by that?
If they fund a mine and the miners find more gold than expected, Franco-Nevada gets a cut of that extra gold without paying an extra cent.
Oh, that is brilliant.
It's like a free option on discovery.
You get the bonus without doing the extra work.
Yeah.
And the dividend story here is the real highlight.
Yeah. The source mentioned something big for 2026, a 16% dividend increase for the year.
And that marks their 19th consecutive year of dividend growth.
Hold on, that's an important distinction. The others were paying dividends for decades. Franco-Nevada has been increasing them for 19 years straight.
Right. They are a dividend aristocrat in the making. Current payout is $176 annually, and analysts like them, with targets around $257.
It's the smart money play. You get the upside of gold prices without getting your hands dirty.
So let's zoom out. We're in 2026. Gold is over $5,000. It's not just buy gold stock, it's choose your fighter.
It really is. You have to match the stock to your own thesis.
So to recap for everyone listening, if you want pure volume and believe gold is going to the moon, you look at Newmont, the heavyweight. Just be mindful of that premium.
Right. It's the crowded trade. And if you're obsessed with margins and want that copper side bet, you're looking at Barrick, the efficiency expert.
If safety is your priority, no geopolitical headlines, no debt, then Agnico Eagle is your safe haven.
And finally, if you love high margins and hate operational headaches, you go with the banker, Franco-Nevada.
It all connects back. The source emphasized that analyst optimism is still there, even with high prices, but it's selective. It's about picking the right boat for the right type of water.
Exactly right. And you have to remember, a mine collapse can tank a stock even if gold hits 6,000. You have to know what you own.
You know, before we wrap, one thing is sticking in my head. We rattled off those dividend stats.
38 years, 39, 43.
It's incredible. Think about what's happened in the world over the last 40 years. The dot-com crash, 2008, the pandemic. The price of gold hasn't just gone up, it's crashed. It's been in the doldrums for years.
And that is the provocative thought to leave with. How did these massive entities maintain such consistent payouts through all that volatility?
It suggests a resilience that goes way beyond the daily spot price on the news ticker.
It does. It implies these businesses are built to survive almost anything. They are structured for the ultra-long game. While we obsess over next week's price, they're planning for the next decade.
They think in geological time, not quarterly earnings time.
Precise.
Well, on that note, we'll leave you to ponder which personality fits your portfolio. A huge reminder that this was a deep dive into 2026 market data. Things change fast, so stay sharp.
And always, always do your own homework.
Thanks for listening. Stay curious.